Hi, thank you for joining. This is Datta Khalsa. This is BTS Presents Silicon Valley Real Estate Behind the Scenes. This is the April edition. For this show, we're going to be discussing the post-COVID-19 market as it's been impacting the local real estate. And I have a distinguished panel. We have Paul Vannerus with Omni Financial. He's a very well-respected local loan broker. We have Chris Shoemaker at Shoemaker Commercial, a commercial real estate broker, a longtime local, and then Darius, Mohsenin, who is a longtime local rental property provider, both in the Santa Cruz County and surrounding counties. So thank you, gentlemen, each for making available your unique perspectives on the current situation. I think I'd like to start with, I guess it all starts with the tenants, really. So Darius, how has it been? We have our first round of rental cycle is in, and I saw a local survey that was done. Some 700 or so property providers were interviewed, and the average was about 65% for the Bay Area of residential rents collected. Is that roughly where you are, or is it more or less? What have you been seeing?
Actually, I'm much higher because I have a lot of Section 8 tenants.
I see.
And so, yeah, now in times like this, I look like a genius having all the Section 8 tenants. And many of these are on some kind of government assistance like SSI or Social Security, disability, or retirement pensions as well. So that's protected money. And then, of course, the Section 8, the federal government money. But nonetheless, my non-Section 8 tenants, I have had about 5. I mean, I have total about 80 odd or so tenants, okay? And about only 5 have asked for some kind of workout plan. And oddly, ironically, after you contacted me today about getting on the show, about 30 minutes later, my single family home tenants, they asked if they could break their lease early. One gal was worked at Santa Cruz Signs there on River Street, and she was laid off. And her partner is a softball coach at CSUMB, and she's been furloughed. And they're afraid it might extend into September. And so in a 3-bedroom, 2-bath house costing, $3,650 a month, and they're going to need to downsize to a 1-bedroom. And it's like, yeah, of course, do what you got to do. Let's do what we have to do to make it right for you. But yeah, I saw that too. I saw about 30% on average are asking for some kind of accommodation.
Some kind of a workout. And I've seen the various municipalities have actually been very proactive, both locally. The city of Santa Cruz and the city of Capitola got out a good FAQ well ahead of time. And California Apartment Association has a really excellent set of tools that they've made available in terms of letters for landlords to proactively reach out. So, for example, our property management division, which manages close to 200 doors, we've been seeing probably upwards of, I would say, 85 to 90% locally. So it seems Santa Cruz, for all its kind of laid back history, when you look at the performance of this county in terms of the flattening of the curve and also just the mutual respect, I think, between the landlords and the tenants, it's been heartwarming to see. And I guess moving forward, we'll see, if at the next 30-day cycle where we are.
May is going to be interesting. May will be the real telltale sign because people had their money, mostly saved up for April and so forth, and going to plan, of course. And but May will be interesting to see if this continues. There's still a lot of uncertainty, and $450 is the max per week I think you get on unemployment, and that does that works in Muncie, Indiana, but it doesn't work out in Santa Cruz, California for paying rent. So it'll be interesting to see. And
then in terms of commercial tenants, Chris, do you handle much in the way of leasing or the actual management, or are you mostly in the placement and the sales?
Yeah, no, I don't do any, month-to-month management of property, but I am working with a lot of clients that do have large holdings. So, I'm getting some pretty good information, and what I'm seeing kind of mimics what you guys are saying. The national stuff I'm seeing is saying, 60 to 70%. Just anecdotally, locally, my clients are getting calls from tenants. Obviously, there's a lot of pressure on businesses, and it's it depends on the kind of business. I mean, restaurants are under huge pressure right now, all types of retail. So what's happening is that some owners are being proactive. They're going to tenants first. They're working out deals for the tenants who can't pay, whether that's, half rent deferred, whether that's just a tenant paying the operating expenses. Some of them, quite frankly, can't pay anything right now because they're waiting on the SBA disaster relief money that's still not here.
Yeah, the PPP.
So things are up in the air right now, and the uncertainty seems to be kind of the most trying part of this for people right now.
Yeah, and I think there's a lot of creativity. I've seen some of the solutions suggest applying security deposits towards partial or whole rent as kind of a workaround. And then I read an article, I think it was on PropMoto, it was talking about blend and extend leases to quote unquote save the property industry with a complex formula that essentially extends, and these are on longer term commercial leases, extending by multiple years and spreading it out over that time to preserve the cap rates. Have you seen any of those locally?
It's starting to happen, yeah, and you start to see those conversations with the savvier tenants. The national tenants are the ones starting to have those conversations. The irony is that they're the ones that can afford to pay right now, but they're the ones that understand kind of where this is going, so they're getting out ahead of it. But no, it's happening. And to go back to your other point about Santa Cruz maybe being a little different in the relationships with people, I own a small industrial building in Watsonville, and about 2 weeks ago, my tenant called and said, "Chris, I'm not going to pay you." He's been there for 5 years, hasn't missed a payment, but his business is down 90%. And so we had a conversation, and I told him I'd work with him. And long story short, he ended up sending me 1/3 of the rent. So, he did what he could. I told him that I would help him for a certain period of time. Obviously, there's pressure when property owners have a mortgage.
Yeah.
Because, if you're looking at a typical debt coverage of 1.25 and you're only getting 60 to 70% of your rent, it doesn't take a genius to figure out your negative real quick. So,
yeah. Well, and that's another whole side topic, because some lenders, it really depends who you have. Some lenders, I think Chase, for example, is almost an immediate deferment of 90 to 180 days, while others, I think Wells Fargo, for example, I mean, unless you're flat broke, you're not, and you're going to have to also, get in a huge line of backlog. And that's also what we're seeing with some of these, the PPP, the SBA assistance loan. And I have a commercial building in downtown SoCal. It's interesting because the whole COVID situation has changed the nature of tenancies, because these were service related businesses. I've got a hair salon, I've got a massage studio, I've got a personal trainer, and those used to be, those were prime. That's who you wanted because retail was going away, and then suddenly they're told to shelter in place. And I had the same discussion with these tenants, and so we've, in the short run, I've told them, okay, well, let's just wait and see what happens this month, and then moving forward, it's interesting because the debt forgiveness on that SBA loan, they do it. It's primarily to preserve employees. Right. So the mortgage portion, or rather the in this case, the rent portion, yes, they could borrow it at 1%, but the odds of one of those tenants being able to ever repay that, so it's pretty low. So we're looking into things like possible blended extend, but more likely, reduction and possible applying of security deposits towards the rents. And the good to me for all these years. We've got a good working relationship. If you force them out, you're back to probably at best finding a similar tenant and ending up in the same boat. So it's really a case by case, and they obviously have, they care. It's a two-way relationship. So it's interesting in terms of commercial sales, listings, those sorts of things. What kind of activity are you seeing right now?
Yeah, so I have a couple of properties under contract, and quite frankly, they were under contract prior to all of this. Over the last 2 or 3 weeks, things have really slowed down. I mean, it's difficult to even show a building now. I mean, how do you do it? You look at different guidance. Some of the guidance you see says you shouldn't do it at all. Some says if it's vacant, you can. If you can safe distancing. So that's challenging. The other challenge that I'm seeing is that buyers who seem to be in the market right now are in the market because they want an expected deal. Mm-hmm. And sellers haven't been in this long enough to where they're feeling enough pain to where they're there yet. So mm-hmm. you kind of have this impasse to where expectations are different.
Yeah.
And it leads to a little bit of stagnation right now.
Okay. And I have somebody else, a residential agent who I'd invited to join us that I might go ahead and add into the discussion, see how it's going there. I can speak a little bit to that market. The residential, both the tenants and the sales have been strangely more active in a lot of ways. We're still able to do leases, and we're still able to sell properties. I think we closed, and this was with Paul, we closed a very tough non-QM loan this last week. One's under contract, but we're seeing challenges, like you said, Chris, as far as showing them. The association put out some clear guidelines. I'm just inviting her right now. So yeah, they're very clear. If it's a vacant property, then yes, you can show it, but you have a certain protocol in terms of maintaining social distancing, limiting the number of people to 2. They have to be from the same household. But yeah, a lot of the shelter-in-place ones, you can't really market those. And there's been a big upswing in terms of level of service that we provide to address that. So our office, for example, bought a 3D camera. Probably was long overdue, but it's watching the way that people step up to the plate and make things happen is it's another unintended byproduct. So I've got Janet Romanowski, who I'm going to go ahead and send a copy, and she's with David Lyng. She's another good agent out there, and I'm very curious to hear what her take on it is. But let's go ahead over to Paul, and if you can speak to kind of the other side of things. We have the human side, and then we got the money side, which
right.
There are humans running that side, but it's a very complex thing. So what are you seeing? I mean, obviously the non-QM, and maybe you can explain the difference of QM and non-QM, and then what's gone on with the markets and how it's
just the progression of. Well, one thing, just to come back on the SBA loans, because just my family has an SBA loan currently, and SBA just put out a letter stating that they're going to cover the next 6 months on existing SBA loans, just covering that commercial side of things. So that's going to be something that's not a deferment; it's an actual coverage of principal and interest that they're going to take on individuals that currently have SBA loans. So that's going to be coming out. Hopefully people will be receiving those letters. The one from my family was just sent over to me just the other day. So they are coming in the mail, and just people should expect that they shouldn't have to make this month's payment on SBA. So that's something.
A restaurant that I just handled was formerly Santa Cruz Primal, and it's going to be a great mezcal bar. That's got a $700,000 loan on it, an existing SBA loan on it, and that's going to be great news to them.
Yeah.
If I'm understanding this correctly, they have 0 payments, and it's getting by the government for 6 months.
6 months with what was referenced as a potential to extend another 3, depending on how they see essentially the recovery. So that's exciting, just to help small businesses and individuals with those types of loans. So on the residential side of things, it's been such a crazy month of just changes in the market and rates. So just things have changed substantially. You're referencing non-QM, jumbo market both those markets have pretty much gone away, which really make up a big part of, anything over $765,000 in a loan amount. So
and
just
the standard that was enacted after 2008 to basically set a level playing field and proper conduct for lenders, correct?
I'm sorry? The
QM, just to clarify for the viewers.
Qualified mortgages, right? So that was essentially set up to establish just what would be acceptable, and it has, it takes on some of those more difficult self-employed individuals fall into that bucket, and so they're doing bank statement loans and other variations that allow people to get into homes that qualify and can afford it. Definitely, there's affordability consideration that is always going to be looked at, and that's one of the issues today is just lenders' risk tolerance. And so a lot of our changes are based on that. Mm-hmm. And so right now, with pretty much your jumbo market and non-QM going away, you have the Fed who stepped in to back up all of your agency programs, which consists of your conventional financing, VA, FHA, USDA. So just loan programs that are out there, they're safe and secure. And the Fed has referenced that they're going to be a backstop to the mortgage industry until things do recover. So there is that promise of just us being able to continue to do loans, refinances, over this month's time, rates have fluctuated a lot of volatility that's come into play. Again, with most of the jumbo market and non-QM market dropping off, there are options there, but just an example, quoting rates for people on a jumbo, we're at 3.625%, not too long ago. And just running a scenario for a client the other day, I had quoted them on a 30-year fixed purchase on a jumbo transaction at 4.25%. And so that's just the volatility, not as many options that are there, and essentially what lenders are perceiving, risk to rate. There's still a lot of risk out there right now. So. Okay.
And in terms of getting loan locks and the time of processing, is that changing?
So it's that varies quite a bit. So I have certain lenders that just won't allow you to lock until you're ready to go to loan docs. And so you're sitting there with some uncertainty, but those lenders do perform quicker. I have other lenders that have stopped accepting any files. So I have some lenders that are just trying to process their pipeline that they had before this started. And I have other lenders literally we're a month into a refinance and they're just starting to touch files. So it's so broad as to how this crept up on lenders and how they prepared themselves, because initially it was, we had wonderful rates and everybody was coming to refinance. And so we went from that push to then just, the quarantine, everybody working from home. So the industry is dealing with huge demand, but nobody's in the office. And so that's affected just your lenders from their processing, their intake, to their underwriting, to their closing departments. As you've referenced in the real estate sales showing homes, you have issues with appraisers getting out there, to title companies then also working from home. So it really, I think that business has done really well in navigating this, and everybody, changing their work habits and being at home. It's funny. One of the things I was reading, one of the biggest segments that are benefiting from this are our dogs, right? So they're just really enjoying everybody being at home. So that was a funny one that I had read. But just with this, again, a lot of changes in the business. I think things will start to adjust. And, again, with people looking to buy or refinance, just an expectation of 45 to 60 days to get a transaction done.
Mm-hmm. Okay. So a little bit longer time, but the loans are still out there. So, and then I've got Janet Romanowski on the line here. We're going to try and get her to start up. Wanted to ask a little bit about what she's seeing in the residential market. But I guess if you could talk a little bit more, Paul, about what's going on with the mechanism of things. I mean, appraisals, I've been getting some lenders, one
Yeah.
day they say we're doing drive-by appraisals, next day they say no, we have to do a full appraisal. I mean, is it a little bit
Yeah.
upheaval?
So just, it really does depend. And so getting those appraisal waivers are so significant. And so in our area, Santa Cruz County, it's really difficult to see those come out sometimes up in the San Lorenzo Valley just because things are so unique. But if you're coming out, if you're doing a refinance and there's been a Fannie or Freddie loan on there, you're more inclined to see that waiver come out. And so also, they're starting to do more adjustments with leniency of just, doing the drive-by. For instance, I had a client, and again, things have been changing so quickly, and I had set up the appraisal, they had scheduled it, and then that next day they had set up essentially an appraisal waiver. Really, if you push back, in a lot of cases, that interior appraisal can turn to just a drive-by. So really just from an individual who wants that safe space, just to push back on it, ask the appraiser, and, usually we'll come back to the lender, but I've seen cases in the last week or so where they've changed it. And again, with even some documents where I'm doing a subordination for a file, a refinance, and they're needing something notarized. So just to push back on things, just to try and simplify. And in a lot of cases, when you do take it back to the lender, they're okay with forgoing a lot of the formalities.
What kind of rates are you seeing right now in conforming and non-conforming?
So quite a bit of volatility. Even in this last week, I've had some files we've been tracking, as of last Monday, on a conventional loan under $510,000 with an equity position, good credit. Just in this last week with files, 3.5, and then back down to 3.25. So we locked files Thursday, Friday as rates improved, kind of expecting that we'll see further improvement from that. And as far as rates, the 3.25 is what I'm seeing on just a conventional 30-year. The interesting thing today is it's the same on a 15. So you're not seeing that quarter or so improvement going to a 15-year fixed. Again, 510,000, that conforming limit is crucial. Once you go above that, you usually do see a higher rate. It's even more so today. So just, I have another client we just locked in at 3.99 on a $620,000 cash out transaction. So still a good rate. It's up quite a bit from, a month back. But, rates are trying to stabilize. And again, they do work inversely to, as stocks and other segments of the market move, you do see improvements or just the volatility in, our mortgage-backed securities.
How about, say, 10% down or self-employed? Do you have some programs for them still, or is that pretty much all gone away?
Yeah, absolutely. Absolutely. And just, the other thing that I'm starting to see with files is lenders are starting to have their overlays, meaning they're starting to put on more requirements to underwriting files. And so, for instance, I have a couple FHA purchases going in, and with, reaching out to my lenders, a couple of them didn't want to see any self-employed borrowers for the next month. And then, I have other lenders that just, again, are fine with it, are looking for files and processing at a normal rate. And again, some are underwriting to the basic guidelines. Some are putting in some criteria that, again, to their risk tolerance, that they want to see borrowers either have, more reserve, or again, questioning, landlord history and different things like that. So, you will see some quirky things that do come in. As a broker, I go out, reach out to my contacts with lenders and review them and make sure that we're not going to see any of those, overlays that can sidetrack files.
Okay. And Chris, are you seeing, you said you've got a couple escrows going right now. Are you seeing any issues with funding those loans or any changes as far as the conditions?
No, just time. Everything is just slower right now. It's harder to get inspectors out to look at properties. As Paul said, the appraisal can be slowed down a little bit. Escrow, sometimes you're dealing with an escrow officer that's working from home.
Yeah.
So things are just a little bit different right now. So I think time is the biggest, and just that general unknown. Most of the people I'm dealing with, it's a little different. It's not somebody looking for a home to live in. It's somebody making an investment decision. So, a lot of times they're just taking a wait and see. Is this something that I want to make a decision right now, or do I want to wait, 14, 21, 30 days and kind of see how this thing's playing out?
Yeah. Okay. And we have Janet Romanowski from David Lyng has joined us, longtime experienced local residential agent. So what are you seeing out there in your part of the residential real estate world locally?
Oh, good question, Datta. Thank you very much.
Yeah.
It's very interesting. Everyone, of course, is calling. Clients are calling, asking what's happening. What do you think? And I just think it's still kind of too early to really understand what's going on. Unlike, for example, in '89 when we had the earthquake where you lost housing stock, housing went down, houses fell, and all of a sudden you had some people saying, I need to buy or I need to move out of the area. This is real confusing because we haven't lost any of the housing stock. All we've done is just very rapidly change the scenario on what was going on. I have an escrow right now on a piece of property, and you guys were mentioning about financing. In our case, financing became very difficult. It was not a traditional Fannie Mae, Freddie Mac type loan, and all of a sudden the financing dried up for what this person wanted. It was non-QM type financing, qualified mortgage financing.
Yeah.
That market is completely dried up at this point. So if you've got someone that's not Fannie Mae or Freddie Mac, you're looking for another source right now, and it's hard to find. I'm getting calls.
Paul's mentioned he has at least one source that's still there, right? Is that correct?
Paul, you have someone that's non-QM?
I think that's part of the joy of he has one
Okay.
good source as well as one that had
Good. I'll talk to him afterwards. So I do think financing, and maybe it's a little bit what Chris said, is that I believe it was Chris. It's not that financing isn't available, but you're right. As everything sort of got readjusted, all of a sudden appraisers want to go through gyrations to figure out, is the house vacant? Has it been sterilized? So it's just things are taking longer. I did have an escrow fallout. It was happening right about the time the SIP went in, and the person's financial advisor called and said, I can't advise you to do this. So there's just a lot of confusion that's out there in the market. I really believe we're kind of the first third of April. I would say that by the time we get to the end of this month, I'd give it another 3 weeks or so. I think we're going to have a better sense of where this market is going. I just feel at this point, I don't know that there's a clear direction. And what I have is people will call me. Someone said the other day, well, the Seattle market's booming, it's doing great. And I just don't understand looking at the stats right now. If we've only been in this for a short period of time, I don't know that people can really look at that and have a clear picture of what's booming and what's not booming, because things right now may be going into escrow, but they're not going to close for 45 days. So we haven't even gotten to that first kind of swath of closings.
Well, it's interesting because I was looking at statistics standpoint. New purchase apps are down 21% nationwide. California, they're down something like 30%. But when you look at the local inventory and the rate at which things are going into escrow, because half the market can't be shown, the ones that can, the vacant properties, there's
Yes.
actually a higher demand. I'm seeing multiple offers.
Yes.
I don't know if it's sustainable, but in an odd way, we're actually seeing overbids and seeing values, at least in the short run, maintaining where they were. So it's uncharted territory, I think.
Well, and I would jump in, the media wants to publicize, they want to sensationalize whatever's happening. That's what news is. That's what people read. So the other day I read something where it says, the real estate market is down or something. So it was it was a very strong statement. But what you realize right now is it's down because we can't show property. There's a reason. They're not necessarily talking about prices. They're talking about numbers. And right now, yeah, you can't show, you can only show probably 25% of this market right now. The rest of the houses are just sitting doing nothing. You know, we can't show. I had a request from a client today. The best thing we could do is just have them drive by the house to see where the location was. And that's it. So that's the kind of house I expect nothing will happen on that for 3 or 4 weeks, or at least until the SIP is lifted.
Yeah, absolutely. And I just personally, I can't see them lifting the SIP on, is it May 3rd or May 9th, because everyone's kids are, home until, basically they're going to be homeschooling for the end of May. So I predict it's probably going to extend through the end of May, as it's done in a lot of other counties. So Paul, I guess the question was raised about non-QM sources, and you had told me when we were talking today, you have at least one source. I mean, if somebody needs that, what can they expect to pay on an interest rate right now if they were to call you?
So it's going to be detailed to how the structure is, and so with non-QM you can look at bank statements, you can look at 2 to 12 months of, or even 24. You can even do a full documentation and just utilize tax returns where doing a conventional route, there's something in those tax returns that normally wouldn't allow you to utilize all the income. So interest rates are going to be quite a bit higher as far as each one of those scenarios goes. So you could see rates probably 5 to 6%.
Okay.
In the non-QM area.
So you're still not looking at private money rates. You're somewhere, on the closer side to a conforming than to a private money loan.
You definitely are. Yes. And even in the fees that are associated with that. So in the non-QM, from a lending standpoint, in some cases you will have some origination. Again, I had one source that has come back into the market, and just with that, I'm sure you'll start to see more re-enter. And so, you did have such a issue with liquidity and then confidence in our markets. Mm-hmm. And so you had just everybody vacate the jumbo area and the non-QM. Yeah. So again, this quickly to see, a non-QM option come back in is really nice. It's promising. Again, I have
that's some of the best news. That and the SBA, that's huge. Because I handle a lot of business opportunities, and I know those people have just been just wondering what they're going to do. So so that's good. I sense a general attitude and a belief of hope amongst the various panelists here, and I'm glad to see that I'm not alone in I don't feel delusional, because I'm seeing enough and hearing enough from the various sources here. And as usual, we've run into a time crunch at the end of our show. I really appreciate you each being available and on relatively short notice and accommodating us. We lost our studio this month. You can't shoot these panels like you used to with everybody standing right next to each other. So hopefully we'll be back online in 2 months, but you might expect another panel like this, speaking to you, the viewers. And again, thank you each very much. Welcome back to a continuation on our discussion. We have a panel of 4 fellow professionals in the local real estate industry speaking about the post-COVID-19 climate for real estate locally. And this is the BTS Presents Silicon Valley Real Estate Behind the Scenes. So just to recap, I have with us Chris Shoemaker from Shoemaker Commercial Real Estate, Janet Romanowski, Associates, residential specialist. We have Paul Vannerus from Omni, is it Omni Financial or Omni Fund? Omni Fund, a residential broker, and who has a bit of a reputation for taking on the impossible and usually making it happen. And then Darius Mohsenin, who is a local provider of residential rental properties. So thank you all for continuing the discussion. And I think during the break, Darius had raised the question about this new. I have to say, I'm not generally a huge fan of government, but I'm seeing a lot of good things being done. And one of them is this extension on 1031 exchanges. So Darius, what have you heard about that?
Well, I just checked in with Ron Ricard. I don't know if you know Ron from over in San Jose.
Yeah.
But yeah, he's a real expert because I'm currently in an exchange, and it would be nice to get a little more time. So I reached out to him, and he just replied. I think it was yesterday, in fact. So, and what you just said, Datta, earlier about the various deadlines.
Yeah. Well, yeah. The understanding is that the extension right now is any notice that occurs between April 1st and July 14th to July 15th, and they're working to try and change that date from April 1st to January 20th so that it applies to more taxpayers who are currently in there. Chris, are either of the transactions that you're handling? You have a couple transactions going right now, or either one of them impacted by this in any way?
Not the two that I referenced before, but I am working with some buyers who have closed on the down leg and are looking for up leg properties. So this will help. I mean, anytime you get extra time on the exchange, it's great. You know, the 45 and 180-day deadline are, most difficult part of the exchange, obviously. So every little bit helps. Yeah.
Well, particularly because earlier in our last segment, you were talking about the length of time that the loans in particular are taking to close. So I think the 180 could become more significant.
Oh, it can. Yeah. It's certainly if there's financing involved, and even if there's not, just the logistics of finding property right now, and being able to get in and really underwrite it and be able to inspect and make an informed decision. So, whether this gives people another 3 weeks or so, or whether it gives them another 3 months, depending on where their timelines fall, it's all going to be helpful. And I think it makes sense, with having the extension of the income tax, this kind of mirrors that. So it makes perfect sense to me.
Yeah. And Janet, you've seen, obviously the MLS has jumped in and they suspended days on market from accruing.
Yes.
What other changes have you seen that have been helpful?
Well, it's a good point. And when Chris was saying about the exchanges, for example, I had a duplex that was going to come on the market. But if you can't show it, if there are tenants living in it, if it's not vacant, you can't put a duplex on the market. So when you start looking at someone in a 1031 exchange, a duplex is a logical thing for many people to buy, 2 to 4 units, but you can't do that right now because you can't show property. So I think the 1031 it was really great to see that they were going to give those extensions. I think it's very needed at this point. I have the one transaction, which, Paul, you're going to be my miracle worker from what I understand, to help me with financing. And then I have a listing where it fell out of escrow. And at this point, we're not showing it. We're going to wait till the end of the SIP. So that's what I've got going.
What are the main reasons you're seeing financing fall apart, Paul? Or if anyone wants to speak to this, what are the biggest causes?
So as far as items that have created fallout, so I've been fortunate to not get caught up in the jumbo fallout, because jumbo and then that non-QM. So everything that I had either closed or just, has stopped. And so in speaking with some of my lenders with those jumbo pipelines, they had tried to fund transactions that were locked, that were, had docs out, but it got so critical that lenders just started declining things, and they just had to decline their pipelines because they were getting stuck with those funded loans on their lines, which then just can be so impactful and detrimental to how a lender operates. So, the jumbo sector and non-QM, as it went away, it really created a lot of issues. And so people that were in transactions, if they didn't fall out, I think moved into some private money options if they were available. And so I think a lot of those, clients that got stuck have, essentially fell out of their transactions. And again, there are jumbo lenders out there. I have 2 that will close, one of them offers a 30-year fixed. So those timelines are going to be longer just because the market's condensing. There aren't as many options. So 60 days, I would even have to check, and it might even be a longer time frame. If I only have one option for a 30-year jumbo fixed loan, it's
for commercial, Chris, I'm seeing and hearing kind of a return to the market of some of the conduit lenders that we hadn't heard from for a while. Are you seeing that as well?
Yeah, so, as Paul said, things have been just so up and down over the last month with rates, with lenders being interested in a project and then pulling back. And it's just been kind of frothy. So to say that, people are in or not for sure at this point, I think it's still difficult because I think lenders themselves are still kind of trying to figure out where they fit into this and how much risk they're willing to take,
Yeah. And Darius, I see you have a question about buyers and possibly renters' expectations. Do you want to?
Do any of you on the front lines there, are you seeing buyers like, just licking their, rubbing their hands and licking their chops like, we're going to have a 20% correction. I just got to sit back and hold my cash and wait for the market to crash. And then our favorite tenant activists here in town are all just, loving this, to see landlords suffering and possibly and rents are going to drop. What do you think? I just, and correct me if I'm wrong, but in the recession 10 years ago, what was the worst we saw in a correction here? 15%?
At most, I think. But Janet, I saw you nodding your head vigorously. Do you want to jump in here?
No, go ahead. I'll come back.
One thing to add to just, the rental market in Santa Cruz, you do have UCSC that vacated their dorms. And so that's going to be a huge impact to just numbers, kids looking for, kids looking for, homes, or whether they're, more impact on the residences that, are already housing some of these kids. So I would suspect that rents aren't going to go down. That would be my thought.
I'm seeing because my office handles both sales and rentals. We're getting, and I judge things in, I don't predict economically very far. I look at the unsold inventory index, the rate at which things are going pending, the volume of calls that we get. And with the exception of business opportunities, for residential sales and for residential rentals, if anything, I'm seeing more demand on the sales because, so the stuff that's available is actually getting some overbids. And I'm hearing in the mastermind group that I participate in, similar things from 12 other top agents in the county. So in the short run, it's kind of this interesting microcosm. Is that sustainable? Hard to say. And I don't know, what kind of questions or what kind of questions are your clients asking you, Janet? And how are you responding to them? Well,
let me go back to something that it's interesting. When I go back and I think about when Measure M was going through, and a lot of confusion that was when we were voting on the Measure M, where a lot of people that were selling properties, we were losing rentals, and they were going to owner occupied. And I wonder if something like that might happen again, is when things are resold, typically in Santa Cruz, a lot of rentals are going to owner occupied. And so the whole issue about the rents going down, I don't see that we're going to have, rents would typically go down if we have too many rentals and not enough people wanting to rent. And I just don't see that happening. I think what we'll end up with is, like we've seen in the past, we're going to have a continuation of people selling property, possibly selling rentals, and not going back to being rentals, but going to be owner occupied, which again just loses housing stock. So I don't know about the rents. I mean, where I would see the rents would go down is if we start to find, for example, our engineers from San Jose, our workers here in town, if they don't have employment and at this point they give up and move out of town, or just really need to downsize into something smaller, then I can see that certain segments of the market, maybe some of the higher price rentals, may suffer a little bit more because we don't have all the people coming over the hill. But other than that, I don't see the rents changing a lot.
And I think a lot of those people that used to commute are working from home now. I mean, yes. Zoom stock has never been as high as it is, and I know it's hard to predict beyond 3 to 6 months. And kind of our litmus test, I suppose, is Wuhan. They're back their lockdown was lifted, and kind of looking. I don't think it'll ever be the same, but on a bigger scale, all of the reputable economic reporting I've seen says that for the last 40 years, every time there's been a recession, real estate hasn't followed it down like it did in 2008. That was the one exception to the rule, because it was related to the mortgage crisis. A lot of the other times, particularly investment real estate, was seen as almost a safe haven by comparison to when there would be stock market crashes. So there's a couple of good blogs I could send some links to that when later on. But
Datta, can I go back to something? What I was going to jump in earlier, but we had gone over to Chris with the commercial lending, is let me go back to Paul on something.
Mm-hmm.
I recall that right before the SIP went into place, we had a situation where people were jumping in with all the refinances because rates were so low.
Right.
We had a lot of people jumping in, and I know certain lenders started adjusting the refi rates to sort of cool that down so they could get more of the residential people in. They wanted to push through the residential loans more. And I'm curious, with now seeing not as many homes selling, what's happening with the refi market right now? Because I know they were they were pushing them off. And I know with a lot of lenders, they were telling you, you're going to take longer because you're refi. But now it almost seems like that's the segment of the market that they can get the loans with right now, is the refis instead of the purchase.
So just with that, you have it's so going to the conversations I'm having today, it's interesting, that progression. I still have people that are like, hey, rates have got to be wonderful. I hear they're at 0, right? And so total different consideration to rate. And I come back to just going, hey, that's the Fed's fund rate, total different, detail. And, mortgage-backed securities, there's a supply and demand there that dictates where rates are going to be. And so rates on conventional loans are low, but again, it's not a natural market at this time because the Fed is backstopping all of your agency programs. And so the idea, when we had rates really low, when you go back to that Tuesday that the Fed did an emergency lowering in rate, that was kind of our start to this unwinding. And so, from that date, the following, that that Wednesday, rates moved up, and there's been a progression of rates getting worse. And so when that first started, there was an idea that, when you always have, I call it, when I'm looking at my lenders that are pricing best, I always reference it as one lender's buying the market, whether that's a conventional structure or FHA, VA, it's always a different lender that's pricing the best. And so I had a lot of those, top price lenders that began to fall out, and other lenders that would be lower in my pricing, would be top of the list. And so it was interesting. And I did start to consider, these guys are raising their rates to slow their pipelines, and that was going on. But really there was a bigger issue that was occurring. And it was this start to just how big of a situation this was going to be. You had the stock market begin to decline. And you then had a lot of lenders just become weary of, again, to what extent people were going to lose jobs, the risk of lending to people. And so you just had, this movement out of the mortgage industry, and there's your, fallout of the jumbo market, your non-QM. And again, the Mortgage Brokers Association had asked the Fed to come in and backstop things because they saw it getting out of control. So that's what's occurred. The Fed came in, backstopped it. You still have rates that are off quite a bit, because I still have people that are sitting in really good rates that are locked. We're doing refinances, and they're like, hey, has my rate gone down? Is there potentially get a better rate? And I'm like, no, you need to just, that idea of, because I was closing, VA at 2.75% and conventional loans at 3%. Those options are gone. And so, I have a client that asked me about her 3.625% because of restructuring, if she could get lower because her friend just closed at 3%. And I'm like, yeah, that's because they had locked a month ago and it's been processed. So, as far as, the progression of things, I do have lenders that, you know, are taking this just, it's night and day as far as how they're doing things. I have, you know, one of my lenders, I had files that weren't locked, and essentially they just went, hey, if you're not locked, we're done with your files. Don't submit for the next month. I've had other lenders that essentially don't want to see a locked file until they get to a point that you're ready for loan docs. And I have others that just will lock, and you can expect 60 days to get it done. So how they're taking this on is really varied.
Oh, and it's interesting because it speaks to the emotional nature of markets. And it seems to me that on a national scale, the news took a more positive turn towards the end of last week. I think Kiplinger's had said, I think on Thursday, they expect home sales to drop in the spring and then soar after the health fears subside. So, you know, that's a pretty big source that a lot of people listen to. And, you know, maybe hearing about a couple of these non-QM lenders timidly coming back, and, you know, they sort of follow each other. So
Absolutely.
That's encouraging.
Yeah.
Well, also, what about, I mean, look at the stock market as a, you know, the ultimate harbinger of future. I mean, what's the price of stock based on? Future earnings for that company. And we've now had, what, a week and a half worth of upward, you know, recovery there. Is that, are they putting the market putting a stamp of approval on the fact that the you know, business will recover, the economy will recover quickly, and will be not where the economy was in March 1st of 2020, say, but not very far off?
Yeah, well, maybe there's all those disciples of Warren Buffett. You know, what's his saying? When the market is scared, get greedy, or something like that. So
right,
maybe those people are coming back to it. And, you know, one thing that occurs to me, more stressed than they may have to sell some real estate to save their business. Any calls like that, Chris, from the commercial sector?
Not yet, no.
Okay.
But you know, I think it's still too early for that. Darius asked, you know, are you getting calls from buyers that are looking for a great deal? Yeah, I'm getting a lot of those calls. The problem is the sellers aren't there yet because we're too early in the cycle. And I think that goes to your question as well, Datta. And some of it's going to depend on how this SBA disaster relief deal plays out. If people get their money, how long it takes them to get their money, and how it all really shakes out. The other thing I think is going to be the shelter in place. You know, if we go to the 3rd of next month, that's one thing. They tack another 30 days onto that. That's going to be a whole nother level of pain for people that has a chance to really impact things. So I think it's just a little too early. And you know, a couple of you have brought up the points of how psychological everything is. And that's true. I mean, obviously we have a health crisis, but on the other hand, the economic side is going to turn out to be a lot of what we think it's going to be. You know, our thought process and our behavior is going to determine it. So,
well, and I think, you know, for those vulture buyers looking for, you know, a distressed commercial seller, I mean, it's commercial real estate. You're used to absorption period of what, 3 to 6 months. I mean,
yeah.
You know, a vacancy of that, that's what you sign up for. So unless it goes longer than that, I don't see it being a distressed market situation.
Yeah, I mean, the only other thing is that there may be some commercial owners or some residential income owners that have seen a huge run up in the value of their property over the last 8 to 10 years. And they've just had it, and they say, okay, it's been good enough. I'm going to sell. I'm going to get out. Maybe I'm not at the top of the market anymore, but it's been good enough, and I'm going to take some chips off the table. So that may happen, but really have not seen much of either of those things yet.
Yeah, or I guess on the residential side, people who were about to retire saying, oh, you know what, I'm done. Are you getting any of those calls, Janet?
Well, you can say that, but many of those retired people live in their home, and you can't sell that house right now. So when you think about it, this is where, again, saying that we're just too early in the market, you may have sellers that start coming out and selling. But right now, for many of them, they live in their houses, and it's worthless to put a house on the market, in my opinion, right now, to have it not be able to be shown, not be able to have inspections. Why bother?
Well, and they're even clamping down. I mean, because initially construction was considered an essential industry, and then they said, well, hold on a second. Flooring contractors, not so much. And, you know, we're in the situation, well, okay, real estate is considered an essential industry. if this flooring contractor is getting a house ready to put on the market to make housing available, how are you going to, how are you going to tell this person they need to pay $1,000 ticket and not show up? So, questions that are getting asked in the trenches every day. I'm dealing with 2 listings I'm looking to bring on the market right now. Do you have any stories like that from the front lines, Janet?
We just haven't put anything on the market. I know. I guess the opinion that I have right now is, again, I just think it's a futile effort right now. Even if it's a vacant house, I just don't know that it's the right time to put something on the market. Why not? Unless the person is in a dire financial situation where they have to put it on the market. And I've heard of a couple of those where people are just saying, just I'll sell it, let's figure it out as we go. I just see that for most sellers, I'm of the opinion I wouldn't put something on the market right now. I'd give it 3-4 weeks.
Well, I'm getting a different different opinion from some of the the other masterminds. Basically, it says we're going to put the vacant houses on the market right now because we've got an advantage. There's less inventory right now. This is the perfect time. So it's interesting to hear the opposite being expressed by some of your sellers. So and again, speaks to we're in uncharted territory right now.
Mm-hmm.
So
we need to have the same panel 30 days from now.
I would love that if you guys are good with that. I appreciate each and every one of you being available for this. And 30 days would be an interesting checkpoint. Maybe we've changed our opinions.
Right. Let me ask this. None of us here are macroeconomic experts and so forth, but I'm just trying to understand the impact on the nation's economy when you just throw $2 trillion debt on top of everything else in a matter of 5 days. Bernie Sanders is laughing like, ha, and you guys are laughing at me? And mine caught, and he's always been afraid of telling what his programs cost. The number is $4.3 trillion. That's what the experts say, but he won't say that. $4.3 trillion for Medicare for all, free education. That sounds like a bargain.
Yeah.
How does this work? You just can't squeeze a balloon somewhere and expect it not to pop. I don't understand, and again, I've taken a lot of economic courses. I follow everything, but I'm not seeing anybody with, the right chops and credentials saying this is how it's going to impact our long-term economy.
But Darius, I don't think we have a choice. Right now.
Well, I don't think so either, but what long-term? And I'm talking about
I think
a year,
we just have to do what we do right now to patch what we can to get people through this. I was watching something last night and the opinion was, okay, we're going to do something like this again. It's not going to be maybe as many trillion, but there'll probably be something else if this shelter in place continues. So
there's really no alternative.
I don't think there's an alternative.
What if China says, hey, I'm going to, hey, guess what, US? I'm going to turn, my treasuries are due. Here, buy them back. Things like this.
Well, but they still need us too. So we're again at the end of our 30 minutes, which is incredible to me how fast time flies.
There's so much more to talk about.
Yeah, I will work my best to find a world-class economist to join the panel next time to answer that last question. But I think locally, at least in the short run, I think the impact of the government programs is very positive, and I'm pleased, and I look forward to rejoining with you guys in 30 days and checking in again. So thank you each and every one.
Thank you.
Thanks, Datta.
Thanks.
All right, we'll catch you next time.
Bye-bye.
Cheers.